First, I'd like to start by thanking everyone, all participants and both the organizers, for the opportunity to show this work that has been done jointly with Aloysio Araújo, Rafael Santos, and Paulo Lins. So this is basically work on inflation targeting, more specifically in context of fiscal fragility. So a quick roadmap of what I'll be talking about over the next few 20 minutes, let's say 25 minutes. So first I try to motivate our ideas, where it comes from. Then I move on to the model, and then show a short calibration of said model, and finally end with an empirical example and some concluding remarks. So that's basically what I'll be doing today. So in terms of motivation, I'd like to start with some kind of provocation. Mainly the fact that oftentimes when we look at monetary policy, we use some kind of Taylor type rules. And what that basically implies is that the policymaker is perfectly committed to the inflation target. So the question that we might ask ourselves is whether that is something reasonable to assume. So that is what I'll be trying to answer today. So is it reasonable to assume that inflation targets are always credible? More specifically, there exists a wide, quite extensive literature that links the fiscal situation and the price level. So wide, extensive in the terms of temporal, as something that's been discussed over several decades. In terms of perspectives, I won't go into that, but just to mention that there's a wide literature out there. So that brings me to the fact that this seems to suggest that the fiscal situation of a country is very likely, or is likely to impact in some way or another the target's, an inflation target's credibility. So a quick overview of the model, what I'll be showing you, is we have a model that quite closely related to the work by Cohen Keel. So basically Cohen Keel focused on default on external debt and confidence crisis in that context. So we kind of adapt that particular framework to one of an inflation targeting policymaker. So looking at our model, we basically have a dynamic closed economy with fixed endowments and two agents. On the one hand, we have an altruist policymaker that chooses both current inflations and issue bonds to finance public spending. On the other hand, we have private agents that consume and that form expectations when they decide how much government debt they want to hold. So how we look at inflation in this model is as a transfer mechanism from private consumption to government spending. And depending on the allocation, on your current allocation between private consumption and government spending, it might be optimal under certain circumstances for the policymaker to use inflation to make a transfer from one to the other. And more specifically, what I'll be working towards over the next slides is to show that this very much depends on the debt level. More specifically, I will show later on that there exists a debt interval for which you might have multiple equilibria. So shortly, what I will show is that at very high debt levels, the inflation target has no credibility, and private agents will always assume that it will not be respected. Very low debt levels, on the other hand, policymaker has a perfectly credible inflation target, and will all be assumed that it's respected and credible. However, I will show that in between there exists a debt interval where multiple equilibrium may happen. So what that means is that the policymaker may decide to basically deviate from the pre-announced inflation target. And we will use some kind of sunspot variable in order to select which equilibrium happens. So that's what I'll be working towards. I will show you in more details how we get there. So in terms of timing in our model, we first have a policymaker that chooses inflation, the current inflation. It then chooses how much one period debt it needs in order to finance itself. After that, private agents decide how much debt they want to hold, as well as form expectations about next period inflation. Since we are talking about nominal debt, if they form expectations and inflation happens to be above, they will receive less than expected. So that is basically the transfer mechanism. And finally, the sunspot variable that will select the equilibrium if two different equilibria exist will be realized. So looking at private agents, they choose both how much to consume and how much debt they want to hold. And when they decide how much debt they want to hold, they form basically expectations on next period's inflation, which will determine the price of said debt. They have a utility that's linear in consumption and strictly concave in private spending. So why did we choose that? Well, it's very much something that is common in the literature. But besides, the interesting of choosing such kind of utility is that for very low government spending, you would prefer to increase government spending. So you have some kind of incentive to use transfer mechanism in order to increase government spending. So looking at the budget constraint, so they consume and decide on how much debt they want to hold, and which is basically restricted by the previous debt they bought from they hold, plus the interest rate they will receive on those debt holdings, plus the endowments they receive each period, so fixed endowments. Endowments that will be taxed at a rate tau by the government. Finally, it will be discounted, the said endowments, by alpha, which is a reduced form to kind of capture the impact of unexpected deviations from the inflation target, with the idea that those kind of have negative impacts in terms of productivity. Moving on to the policymaker. Policymaker basically chooses current inflation and how much debt it needs in order to finance its public spending. We make a few simplifying assumptions, especially in terms of the penalty, which is something very common in the literature as well. But the idea is that once you deviate, the cost of deviating will be permanent in the economy. This simplifies the resolution of our model and actually goes against what we want to show is that the policymaker will prefer at some point to choose positive inflation. Furthermore, we also assume that once the policymaker deviates from the target, it loses credibility. So that means that the private agents will start expecting the policymaker to deviate thereafter. So those are two simplifying assumptions. So the policymaker, when deciding on the current period inflation, will decide basically based on how much it can increase utility in the short term by increasing public spending. So it is constrained in its budget by high debt levels and has very little room, fiscal room, to spend. So what it might want to do is increase public spending by using inflation. So in the short run, it might increase utility by increasing public spending through that transfer. However, in the long term, it will suffer from the penalty, which I described before. So basically, once you deviate from the inflation target, you will suffer a productivity penalty thereafter. So you lose, right, in the long term. And the solution to this problem is basically a fixed point, in the sense that the policies make optimal inflation, discretionary inflation, we call it, is optimal given the private agents' expectations. Since they're rational, they know that the policymaker might deviate, so they incorporate that. So the choice from the policymaker is optimal given expectations, and expectations is optimal given the choice, the inflation choice from the policymaker. So what happens basically is if you have a sufficiently high marginal utility of spending, which means that you want to make this kind of transfer from private consumption towards more public spending. And if you have relatively high debt levels that pressure your ability to spend, and if the marginal costs are limited, what you want to do is make such a transfer. So then you choose, the policymaker might choose to opt for, to deviate from the inflation target. So all this we can basically rewrite in a recursive formulation. So what I basically want to point out with this again is that we are talking about an altruistic policymaker that internalizes the choices made by private agents when choosing the optimal inflation. So it's not some kind of maybe evil policymaker or some distorted policymaker that wants to use inflation. No, we are talking about an altruistic policymaker that incorporates private agents' decisions. So what I mentioned at the beginning of my presentation is that there are three possible scenarios. So let's say in the first one, private agents always expect a policymaker to deviate. But if regardless such expectations, the policymaker prefers to keep inflation on target, the sunspot variable will always be disregarded because there's only one possible equilibrium, which is basically to always keep inflation on target. So that will also be the expectations from private agents. On the other hand, imagine that private agents expect the policymaker to keep inflation on target, but the policymaker nevertheless prefers to deviate from said target. There again will only be one possible equilibrium, which is to always deviate from the target, and which is incorporated by private agents when they form expectations. So again, only one possible outcome. And both cases only depend on the debt level. So that is something we show in our paper, that the value function, that particular result only depends on the debt level. However, in between, there exists some kind of debt interval for which multiple equilibria are possible, meaning that if private agents expect the policymaker to deviate, it will do so. If on the other hand, private agents expect the policymaker to keep inflation on target, it will keep inflation on target. It will be the optimal choice would be to keep inflation on target. And we call that particular depth interval the fiscal fragility zone. So that's the zone where multiple equilibria are possible. Again, looking at expectations, what that means is that expectation will be a weighted average that is given by the probability of, let's say, a bad sunspot happening, which will make the policymaker deviate, plus the probability of a good sunspot happening, where the policymaker would prefer to keep inflation on target. So this basically gives the theoretical framework, and I would now like to move to a particular example which basically inspired this kind of modeling. So in 2002 in Brazil, with the perspective of a new incoming government with some different let's say policy framework than the previous one, inflation expectations for the different horizons that surveyed by the central bank basically overshot the target. So around both election rounds, the first and the second round, we can see that inflation expectations for the same year, at the end of the same year, the next year and the year after that, all exceeded the target. So we see this as a confidence crisis, right? So for, in a short period, private agents change the perspective about the expectations about next period inflation. So based on that particular event, we have done some simple calibration of the model that I previously presented. In terms, looking at the functional forms of the utility function, we will have some weighted average between a term linear in consumption and one logarithmic in government spending. So basically why we use here a weighted average is simply because we will play with this particular parameter rho, which we see as changing perception of the preferences of the policymaker. And we will use that to show how changing expectations about preferences can lead the policymaker to go into the fiscal fragility zone. Furthermore, we look at when we look at the penalty function, we have a penalty function that is increasing in deviation, that has a fixed cost for deviating. So if you deviate, you have a fixed cost. And thereafter, it's increasing in the deviation. We also have chosen to limit the potential penalty, in the sense that if you would only look at this particular term, the exponential term, and you would look at the limits, you would have basically 100% penalty. So the idea is basically to limit the potential penalty. In terms of calibration of the parameters of our model, I will go very quickly over it in order to not exceed my time. So beta would basically have chosen the average exposed real interest rate for a very large period. If you would look at the real interest rate for the period around 2002 wouldn't be that different. We have used for the tax rate 35%. That basically corresponds to the general government revenue in terms of GDP around 2002. The inflation target, we have used the one from 2002. And the crisis probability we have defined by using like the country risk as captured by the DMB plus for Brazil around around the election time. And the other parameters are basically used in order to obtain a fiscal fragility zone that an inflation that makes sense in respect with what was observed at the time. So basically, when we look at what happens when you go into the fiscal fragility zone in terms of nominal interest rate, we see that when the target is perfectly assured, when private agents expect the target to be respected, then basically, regardless of your debt level, you will have a fixed nominal interest rate that will be also the real interest rate. However, if you fall into the fiscal fragility zone, it basically jumps, the nominal interest rate basically jumps because you start incorporating the probability of the policymaker deviating from the inflation target. So this is basically what we have illustrated here with this graph. When you are in the fiscal fragility zone, especially with debt levels, lower debt levels, we show that it's optimal for the policymaker to actually reduce debt levels to try to exit the fiscal fragility zone. Because when you are in the fiscal fragility zone, you have this probability of falling into, well, basically fiscal dominance, where you deviate and people expect you to deviate thereafter. So that comes with a penalty. So you try to avoid that from happening. And for lower debt levels, it's optimal to actually try to exit the fiscal fragility zone. However, if debt gets too high and trying to exit the fiscal fragility zone will pressure spending too much. And so you will basically continue increasing debt until you fall into fiscal dominance. So what it basically says is that if for very high debt levels, you come, you have some kind of inflection point after which monetary policy will no longer have fiscal support and your inflation target will lose credibility at one point or another. And just looking at what Brazil did around 2002, we can see that is basically one of the things that they try to do. So they reduce debt, increase the primary surpluses. So basically something that would be optimal from the point of view of our model for lower debt levels. Another interesting point is that the target functions as an anchor for private agents when they form expectations, because they included, they always give a probability to the policymaker keeping inflation on target. So it functions as an anchor. So what that basically means is that high inflation targets might be more credible. So that is something that we conclude from our model, is that high inflation targets might prove to be more credible up to higher levels of debt. And again, Brazil around 2002 increased inflation targets for both 2003 and 2004. So something that makes sense from the point of view of our model. So in order to answer the question, so how do you fall into this kind of fiscal fragility zone without changing your initial debt level, without some kind of change in fundamentals? So what we have done is, as I mentioned before, we have used the utility function, and especially the parameter that I mentioned, rho, which gives the preference between consumption and government spending. So say you change the optimal allocation between private consumption and public spending in favor of the latter. So if you have some kind of unexpected, unpredictable MIT shock to set parameter, you can actually fall into the fiscal fragility zone. So that is what is illustrated here in the graph. So you have a shock to set parameter, and it could be enough to make you fall into the fiscal fragility zone. So what you see is that you expected inflation to be on target perfectly assured. Then you have some kind of shock to the preferences of the policymaker. Private agents change the expectations, might include the probability of you deviating from the inflation target, which basically means that expectations will increase, as illustrated here. So finally, and very briefly, since we don't have much time, we have tried to test the first order conditions of our model. So the first order conditions of the policymakers' problem for discretionary inflation, reminding that what we expect based on our model is that with higher levels of debt, you will have higher deviations. Furthermore, we also expect that higher targets might be more credible and hence associated with lower deviations. So the very, let's say, vanilla test, which basically is the first order conditions from our model, is illustrated here in the first column. And what we see is, just to say on which data we have used here, all inflation targeting countries that have had an inflation targeting regime for at least 15 years. So panel data for the last 20 years. So using that panel data, we have tested our first order conditions. So looking at the results, what we basically see is that for countries with revenues that are compatible with middle income countries, higher debt means on average higher deviations from the inflation target, which is what we expected. And furthermore, we see that higher targets are associated with lower deviations from the target. And in order to do some kind of robustness checks, we have included different types of shocks, be it to the exchange rates or being usual GDP gap measures. We have also included time fixed effects in order to capture global shocks to inflation. And the results basically don't change much. So they are maintained. So concluding, we have showed with our model that an indebted and altruistic policymaker may prefer to deviate from a pre-announced inflation target. The policymaker can either decide to decrease debt levels in order to give the fiscal support to its target, or it can choose, or it can also choose a higher inflation target that is more credible in adverse fiscal situations, meaning up to higher debt levels. And with this research, we kind of extend an invitation to think about the credibility of inflation targets in models, and especially in fiscally fragile situations, which probably after this pandemic will be more relevant than when we started this research. So thank you all for your attention, and feel very free to ask any questions.
I guess I have one question.
Sure.
So how do you link your paper with the usual literature of fiscal dominance? I mean, is it are we saying more or less the same, or I mean, how do you compare?
Sure. Excellent question. So when you say fiscal dominance, you already probably have something very particular in mind. I think our papers may be a little bit more nuanced, in the sense that fiscal dominance is a very particular event for very high debt levels, where there's absolutely no credibility of the inflation target, where private agents expect the policymaker to deviate. But that's not the focus of our paper. The focus is the kind of gray region in between. So where the policymaker might deviate, but might also not. So I think that's a little bit different from maybe from the usual literature.
I see. That makes sense. Thanks. Any other questions? Or should we move to Victor? I'm not seeing Victor here. There we go.
Todo mundo consegue ver minha tela? Ela não está
Agora,
no...
Agora
Pode
sim.
falar. Tá, acho que ela não está no modo cheio, né? Deixa eu botar aqui. Eu só ia pedir, eu vou controlar aqui o tempo pelo telefone, mas só pedir para me avisar uns 5 minutinhos antes, se der dos 30 minutos, porque muito provavelmente eu não vou conseguir cobrir toda a apresentação, tá? Então eu dou um foco na parte final, aqui faltando em 5 minutos, tá?
Combinado, combinado.
So let's switch to English. My presentation today is Could Intra-Fund Misalignment Explain Price Setting Patterns? This is a co-working with Joe Gillen, okay? So starting by the motivation, and the is very clear in this sense. Our motivation is look to price setting literature. And when we look to that, basically two frictions emerge as the main frictions in that literature, okay? The physical cost friction, usually with many costs, and all the standards of many costs, like a random many cost, there is more fancy today. And the information friction, basically rationing attention and stick information. However, when we look to those frictions, we see that FUM is a black box in their frameworks, okay? They usually overlook to managerial decisions and firm structure, even though papers had already cited the relevance of that. Here we plot a quote from Zabarak and co-authors, okay, that says the following: the evidence suggests that the internal structure of the organization plays an important role in shaping the outcomes of interventions. So our goal is enter deeper in these managerial decisions and how to model that. And naturally, we are talking about the incentives of the firm and the within communication of this firm, okay? We start with a partial equilibrium model illustrating a firm with one good, okay, the simple as possible, and then I will generalize that to embed it in a new Keynesian model with the usual sources that we look in the monetary economics. So starting by this point, we ask a question: what happens when we look to information, structure, incentives, and the within communication in a macro model, okay? So looking to our theoretic, the first one and basically the most important is derive a newly multi-sector new Keynesian incomplete information due to this idea of misalignment in the communication, okay? This idea is the main source that we model the price setting, so we do not rely on any type of cost and any friction on the information, okay? So that is why we have a new model here with a new friction. From that within misalignment in the communication generates price thickness and no neutrality of money, elucidate how it also matters to understand the price setting behavior, the optimal policy, and the welfare of the economy. And in this point about optimal pricing behavior, we can link that with a new unpublished paper from Rafael Scholl and other co-authors about the absence of selection on the data when we look to micro data for prices, okay? Because usually when we work with many costs, we have the key assumption that the probability of the price changing the next period is related with the price remains the same. So here to our case, we do not work with that. Our idea is very different, and we win also this idea of absence of selection on the pricing behavior, okay? And we also derive a new Phillips curve where the misalignment of incentives and the number of divisions of a given firm drive their slope. Now, looking to the contributions when we stress our model with a proprietary scrapped retail price database, we answer questions as the following, okay? So explaining why some sectors have different stickiness, why we have so heterogeneous behavior on price setting, and all those questions are related with this idea of misalignment. The misalignment has a clear relationship with the stickiness that we see in prices for a given firm, in prices for firms with higher number of products, for sectors, for the aggregate side of the economy, okay? We also generate small changes in prices and illustrate this idea of absence of selection. Now, when we look to macro aggregate side, our dynamic model highlights the relevance of this source of firms incentive, generating no neutrality of money, creating a negative relationship between the intra-firm misalignment and the welfare, and bringing an idea of reducing power of monetary policy according to the number of sectors in an economy. So how we can understand this code? Basically the following: higher the number of sectors, lower is the power of monetary policy. Why it happens? Basically because we do not consider any kind of strategic complementarity between the sectors, okay? So higher the number of sectors, the misalignment should vanish. The effect in a given sector is pretty small. So the stickiness is pretty small, and consequently, we have a fully flexible price world, and naturally, the power of the monetary policy should go to zero. I have a result to show that in the final part of the presentation. So starting the intuition of this partial equilibrium model, and the intuition here is illustrate the within firms environment. So we are considering that incentives are not perfect aligned. There are two research departments, a micro and a macro, and one boss. A department is better informed about his margin. So the micro is related with the idiosyncratic and the macro with the aggregate. Both departments send information to the boss who decides this price. And how is this message? The boss obtains this message through a simultaneous meeting with them, okay? So in this slide, it's pretty clear that you have an information model, but we need to understand better how is the transmission of this information in the model, which is related with this last point about this relationship between misalignment in the communication and the private information of the departments, okay? So complementing this idea of two departments, two senders sending information to one boss, a unique receiver, we consider that each margin of the economy has a shock, okay? So we are considering there is a macro aggregate shock, the YT, a micro idiosyncratic shock, ZAT. Both shocks follow uniform 0-1, and there is no contract contingent on the information, which means that the signal, okay, in this game, in this strategic interaction, does not show up in the payoffs of the players. This is a characteristic of chip talk games. So from that, we borrow results from chip talk literature, which guarantees us that there exists an equilibrium for this economy that must be a partition and equilibrium with non-partition, non-symmetric partitions, okay? And what is this idea of partition and how we can call this equilibrium in this economy? So let's understand the relationship between the partitions and the message sent from each department. So I said before that the message is the message about the price. So the firm is deciding the optimal price of a given good, okay? So each department should send a message according to this price, okay? Considering that each margin is better informed, okay? So consequently, each department is sending a partition of the price in this message. And the partition is naturally a range where the price is in this range, but the price of the partition sent should be a discrete price, because this is result from this literature of game theory, okay? So the number of partitions that we have must be finite. Each department is sending, we can think in an example to simplify that. For instance, if a firm is thinking about the price of the pasta, okay, and the micro department says that the price should be 2, and the macro department, the price should be 3, okay? So why you have naturally 2 or 3 as prices, okay? This is an important point of this mechanism. This happens because even though the department receives a continuous shock, the uniform shocks, okay, the price sent in the partition should be finite. This is the translation of a partition and equilibrium, okay? And naturally, if the partition only changes if the shock is big enough. So we have here reminding the idea of subselection and pricing. The price only changes not because the price is the same for several periods or for any other reason. The price will change because the shock is big enough to change the partition of the price. And 4 slides, I have a figure to illustrate this idea. So this intuition is translated here where we have a boss, department A and department B, okay? The M terms are the message, the partitions of the price, conditional to the private information of a department. So if the M term is different than the mu term, we have some sources of misalignment in this communication because the department is not revealing all the information, okay? It can happen for all the departments that we are leading here. So talking briefly about this literature on price setting and chip talk with 5 groups, okay? The first one, the empirical surveys, which characterizes the stylized facts of the literature, the sectoral, multi-product, and aggregate individual good facts. Rational intention is take information and many cause the important trends in this literature. And the last one, this tip talk, or from a seminal paper from Crawford, Sobel, and Battaglini. We borrow this idea where we find this transmission and how is this equilibrium that this transmission generates in our model. Alonso de Sena and Machuchak characterizes this within firm environment, okay? And we borrow that from them. Oops. I jumped several slides. So here it's time to translate, okay, this idea of this new mechanism to the equations of our model. So how we do that? We consider that a department should maximize a conditional profit function. Conditional on what? Conditional on the private information, okay? So each player of this game is maximizing a profit function. This profit function recovers the idea of Makoviak and Widehoff from rational inattention models, where the arguments of this profit function are the following: the idiosyncratic, the individual price, and the aggregate price of the economy, YT as the aggregate shock, ZIT as the idiosyncratic shock, where those shocks must be uniform distributed, okay, at this point. For the macro department, we have the same maximization. The unique difference is with respect to the conditional part, okay? This idea of information, the private information, and how communicate this information matters to our framework, okay? So for the firm's maximization problem or the boss maximization problem, which is the same, okay? The idea is the same as in previous slide, except by the fact that now the information set is composed by the messages received. And as I highlighted before, if we have the M term different than the mu terms, we have some misalignment here. So looking here to this optimal pricing problem, how we derive that, the first step is simple. We should derive an optimal price equation, okay? And this optimal price equation is equation 1, where the optimal individual good price should be equal to an aggregate price and a combination between the shocks. And what I'm calling this optimal price, this is the optimal price under this incomplete mechanism, okay? So that is why this optimal price could be a little bit different than the optimal prices decisions in the literature. And what is important to say from this equation 1, this code relating the Ball and Romer paper with our ratios related with each shock, okay? Because those ratios gives a flavor about the importance of this misalignment. Because if we look to that in this price setting literature, they can be translated as the importance of each margin to explain pricing variations. So the importance in the pricing decision. This idea of the importance in the pricing decision is directly related with our notion of the misalignment in the communication. So how is this communication between one margin, one department, and the boss to taking the decision about the optimal price, okay? Now it's time to engage our players in a game, structuring the payoffs of them, okay? So we are considering that the payoff for each player is the quadratic deviation when we compare the optimal price under complete information with the optimal price under incomplete information. The incomplete information case we derive in the previous slide, okay? And naturally, we derive an optimal price equation for each player of this game. And here we illustrate that. So using this idea of quadratic payoffs, 3 players, 2 senders, 1 receiver, we borrow results from the literature on Tip Talk, which guarantees to us that this equilibrium of this game should be partitioned. And we have a lemma here to illustrate that. If the optimal actions chosen from the micro research department and the board are different for every realization of the idiosyncratic shock, then the set of actions induced in equilibrium is finite. This is analogous on the papers in Chip Talk, okay? And we have here for the relationship between micro research department and boss, but it's analogous when we look to the macro part of the model, okay? So only to understand the last phrase of this lemma, we have that the set of actions induced in equilibrium is finite. How you can translate the set of actions induced? It's basically the partitions of the price that the department send on the message to the boss. And that is why we have that the number of partitions should be finite, even though we have continuous shock. So the next step is write the optimal price equation, considering this partition structure and naturally considering the fact that the shocks are formed. So what is important to say here is those y terms and z terms, we have different equations to translate those shocks in terms of the number of partitions for the given margin of the economy. So we can write the yt term with respect only to the partitions of the macro side of the economy, while the zt terms in function of the partitions of the micro side of the economy. We can disentangle the margins here, and it's very important to the results for the aggregate, okay? Now looking to a first result that we have from simulations of the optimal price equation. We try to illustrate important stylized facts on this literature, but since this model is very different than the usual on the literature, we assume a naive calibration, considering that each margin of each margin is equal to 1, the aggregate price is equal to 1, and we have 3 partitions. The idea of non-symmetric partitions are clear here. We do not choose the values of the prices. The prices are represented in this vertical axis, while the time in the horizontal, okay? We do not choose the prices 1.5, 2.3, and 2.5. It's born from our framework, okay? So look into that, we see clearly some behaviors. The first one is if we trace a line here, we see the idea of reference prices versus sales prices, because when the price goes down to 1.5, they come back to 2.5 again. Of course, that we have situations where the price goes to 1.5 and goes then to 2.3, okay? But it's not the usual. The usual is this idea of sales and then come back to the reference prices. And the result is this idea of small changes in prices that we have here, since 2 partitions are 2.5 and 2.3 are near between each other, okay? And naturally, we have this idea of stickiness because the shock is not big enough. So with the misalignment, for instance, apply the shock to be in the interval of the partition because the department is not revealing completely the information, we have as a consequence of that this stickiness that we can see in some periods of the model. So the price does not vary all the time, as would be expected for a fully flexible price model, because we do not insert any kind of stickiness, the stickiness born from this idea of misalignment, okay? So now look into how we embedded this model in a general equilibrium version new model. The story is the same. We have 2 departments sending information to the boss, okay? But now we include that shocks must be persistent. And we also consider 2 more shocks. One shock related with the sector and another with the fact that firms could have more than one good, okay? So we bring some sorts of heterogeneity in the firm here. And how we address that? We consider that each margin, each department is concerned about one more margin of shock, okay? So now the macro departments send information about sector and aggregate, while the micro departments send information about product and idiosyncratic. So the maximization problem of the firm is the same as before. The difference here are slightly, okay? So we have this idea of shocks incorporated here. Now the sector effect, okay, the sectoral shock, and here this idea of multi-product shock, again conditional to the message received from each department, but we include also a new parameter which captures this idea of a firm that can have other misalignment sources, okay? There is not the communication, so we only put that in the theoretical model. And naturally, since a firm can have more than one good, we should maximize across all the goods of this firm, okay? So look into our Phillips curve. First point, how we derive that. We follow the same steps as before. We derive an optimal price equation. From the optimal price equation, we follow the textbook derivation and find a new sectorial Phillips curve. And how we aggregate this Phillips curve, basically we consider the same as in inflation in data, okay? So, or in any kind of price index aggregation. So look into why this Phillips curve is so different and what this Phillips curve is telling to us in terms of story here. We see that for any specific sector, the optimal inflation of this sector under incomplete information is a function of a convex combination between the actual inflation that we see in the data and the expectation about this inflation, the variation on the expectation of output gap, which brings this idea of intertemporality here, the actual sectorial inflation, as I said before, since we have incomplete information here, we can have difference when we compare the actual result for an aggregate, okay, in this case for the inflation, with our incomplete information. And the last one is this discrepancy term. Summer, talk.
Yeah, you have 5 minutes.
Okay. So this last term is an idea that we have that under incomplete information, a given sector could be very distant from the aggregate actual inflation, okay? Bringing how misalignment matters in this sense. So what is important to say here, and this fancy way to write the Phillips curve, behind that we have our pi ratios as before that we derived from the optimal price equation here affecting the slope of the Phillips curve. So again, we bring a flavor about the misalignment affecting inflation, affecting monetary policy. And this is basically the main two results that we have here. Misalignment of incentives and the number of divisions of a given firm drive the slope of the Phillips curve, because those gamma terms, okay, this gamma and the xi term, and also the communication within the firm affects directly the sector inflation and the persistence of monetary policy. For the household, the Taylor rule, we assume standard assumptions. So I will jump by our time constraint and focus on our database, okay? We have the impulse response functions here, and I will not cover that today. We also have the impulse response function in terms of welfare function, the relationship between monetary policy and number of sectors, the autocorrelation that we have in comparing with the data. But it's important to talk about the database because this data is very different than the usual and this price setting literature. Our data is a daily price data from online and offline retailers, mainly supermarkets, with more than 7,000 products from July 1st of 2017 until August 1st of 2020. Hence, we have more than 6 million of observations for different countries and different continents. But it's important to say the following. For each country, we have at least 2 supermarkets. And those supermarkets are basically the major players in each country, okay? More than that, if a good is sold in Brazil, Australia, and Chile, for instance, we can map the price for a given good for a given brand in Brazil, Argentina, and Chile and compare if this price is changing because, I don't know, only the misalignment or this price is changing because any geographical factor that we should control on the empirical part and things like that. So we can map across the two. So how this data is divided, this data is basically classified in 5 levels. We have at supermarket level, sector level inside the supermarket, category, subcategory, and individual. So we can understand that as the following example. We have supermarket A for Brazil. The sector could be food, category could be pasta, subcategory could be any kind of pasta, and individual a given brand for the kind of pasta that you choose. Okay, that you chose. So what we have here, we have a data that is very different than the usual BLS dominance. And even if we look to the European data as for the UK, that is very, very important in this price setting literature too, we have a daily data. So Dominic's is weekly data and BLS is monthly data. So with this daily frequency, we can try to capture a different pricing behavior within a period. For instance, if the price changes in a week, Dominic's cannot cover that, and we can investigate if it happens. Okay, if we have more sales in a given period, and we can capture that because we have a daily data, for instance. Another important source here is about this pricing comparison across retails. So we can compare from different retails within a country. Dominic's, for who doesn't know, is like a Walmart. This is a big production chain in the US, but it is the same production chain we have for different supermarkets in the same country. So we also have this issue here. And the last one, as I said, we can compare across retails and across countries, which is very different since BLS is focused on US too. So we can think in terms of an open box here, okay? So beyond that, we have the fact that all the prices sold in the supermarket is covered in this data. So we do not have any form of selection here. And naturally, this categorization level engages pretty well with our theoretical partition and equilibrium framework with the margins of the economy. So only concluding here, making a summing up, we built a dynamic model that sheds light on the study about the incentives provision of firms' environment based on within firm communication, which opens a new lack of possibilities to think in terms of price setting, okay? And this endogenous incomplete information, when we numerically evaluate that and we started to stress it with this new database, address facts as sales reference prices, small changes in prices, finite in price setting, and the idea of absence of price selection. And that's all.
Okay. Anyone has any questions?
I have one question, Summer. I'm not an expert on those incomplete information models, but something I was wondering during your presentation is how the implications of your model would be different from a standard rational annotation model. Because at the end of the day, in a rational annotation model, you're going to have a macro shock and a idiosyncratic shock, and the firm has to choose how to allocate attention to the macro or to the micro. Here, it seems a similar structure because we have a micro department, a macro department, both send messages, and something that wasn't clear for me during your presentation is how what the firm will do with those messages in a way that your model implications would be different from the standard rational notation literature.
Okay, we can think in two steps. We can separate them. The first one is in terms of the idea of the mechanism. I think that the idea of the mechanism is different because here we're talking about revelation of information and not the acquisition of information as the usual on rational inattention literature. And the second point that I didn't show here is about how the model lead when we simulate that. For instance, for the non-neutrality of money, we have an important result in terms of that. So when we look to the results of non-neutrality of money, we can generate non-neutrality of money without problems. And if I'm not making a mistake, usually in rational inattention, only Mateka allows the idea of discrete prices in the AR paper. So it's pretty hard to have in rational inattention literature this idea of discrete prices on the pricing distribution. but I'm not sure if I answered your question.
You did. Thanks, Victor.
Any more question?
Okay, if not, let's go to.
Okay, I'll stop my screen share here.
Okay, thanks. Video on. And see my slides?
Yeah.
Okay. We will present this paper on the relationship between the dollar and emerging market economies. The usual disclaimer applies. I mean, the views are mine, not the Fed board or anyone on the Federal Reserve System. So let's start with the motivation. We've seen a predominance of the dollar in trade and finance, and there is this increasing focus on the importance of dollar movements for emerging market economies. I mean, looking at simple correlations, contrary to what we would expect from the traditional Mundell-Fleming trade channels predictions, dollar appreciations have been accompanied by weaker EME GDP and investment, and the correlation is pretty strong. You can see here in this chart, it's a negative correlation of 0.84 for the GDP and 0.85 for the investment. So it looks like that a strong dollar is bad for EMEs and not good as you would expect if you just look at the usual Mundell-Fleming framework. Yeah, and so the focus of this paper is just to have a more structural model, that empirical model that evaluates this, and then we would look at different transmission channels to see if these transmission channels that have been recently studied in the literature actually are working here to undo this usual Mundell-Fleming trade, let's call it trade channel of exchange rate movements, okay? So let me start with what I'm not talking about. I mean, the exchange rate obviously is endogenous and responds to other shocks in the economy. But there is this long exchange rate disconnect literature where macro fundamentals disconnected from exchange rates. The real exchange rate tracks closely the nominal exchange rate. And we have this failure of the uncovered interest rate parity. It usually never holds. So what I will do here, and I want to make this clear, is I mean something that I'm working on, but I don't have any result now. So I will be now very agnostic about the source of US dollar movements. I will just say, okay, given that there is a shock in the US dollar, mainly the broad US dollar, how these shocks are transmitted to the real economy. Okay, so how are dollar movements transmitted to emerging market economies? We have, as I said, the traditional trade channel. I mean, if your currency depreciates, your net exports go up because you have lower export prices and higher import prices. You export more, we import less, and then this should be expansionary in a sense. However, there are some mitigating factors that were emphasized recently. Global value chain integration. So then if you have a high import content on exports and imports would tend to move together, and then you wouldn't have this effect that if exports go up, imports can go down at the same time. So they would it dampens a little bit the net exports response. And also you have this dominant currency paradigm, which it has been shown by Vita Gopinath, a lot of different co-authors, which is this prevalence of dollar invoicing in trade. And in a sense, I mean, if everything is invoiced in dollars, you mitigate the response of exports to dollar movements, and then again, you would dampen the effect of the traditional trade channel. Then you have a balance sheet channel, so EME depreciation can weaken balance sheets and then weigh on activity due to tighter financial conditions. And finally, you might have a monetary policy credibility channel, which is, I mean, if you have a less credible policy, you would have a greater pass-through of EME depreciation to inflation, and then you need tighter monetary policy to combat that. So here what I'm saying is that, okay, you have this traditional trade channel, but you have all these other channels that might actually either reduce the effect of the EME depreciation or even, I mean, invert it. So if you add up all these channels, the predicted effects on output, investment, and exports of the EME depreciations are kind of ambiguous. So you don't know if, I mean, output would go up or down. And so what I do here is mainly provide estimates of effects of broad dollar appreciations on EME real variables using this structural panel VAR model. And then I will examine if effects differ according to country characteristics, splitting the countries that I have in different subsamples. Let me give you a preview of my main results. So US dollar appreciations, which is emerging market depreciations, that's output, investment, credit, and imports contractions in EME. So everything actually goes in the opposite direction of what would be expected by the textbook model. Also, these appreciations have very small effect on exports, which is consistent with this dominant currency pricing. The results are true regardless of how we divide the countries, although the magnitudes vary with country characteristics. So if you have more trade invoicing in US dollar, if you have lower global value chain integration, you have greater contractions after a dollar appreciation. If you have a higher share of dollar credit or lower monetary policy credibility, you also have a greater contraction after dollar appreciations. And these results are robust to different time periods and the inclusion of additional variables such as commodity prices. And particularly for the pre-GFC period, US GDP and real interest rate reverse the direction, but EME variables go in the same direction. So in a sense, this kind of points to that independently of the shock that you have, it would be bad for EMEs if you have a dollar appreciation. But I mean, this is more just, I mean, a time series perspective. I'm not actually separating which shock is driving what. Okay, so what's the empirical model? I have a structural panel VAR with country fixed effect, and I have all these variables. US GDP, US 2-year interest rate to capture also some monetary policy expectations, the VIX as a measure of global risk aversion, the real broad US dollar. Here I have the real, but if you have the nominal, the results are more or less the same. And then for each of the countries, I have GDP, investment, exports, imports, real credit, the country risk, and the real effective exchange rate of each country, just to check if they are going in the right direction. The identification is pretty standard, simple recursive structure. The dollar affects EME variables contemporaneously and with lags, but affects other US variables only with a lag. The countries in my sample are Latin American countries: Argentina, Brazil, Chile, Colombia, Mexico, and Peru. And then I have South Africa, Turkey, and some emerging Asia countries: Indonesia, Korea, Malaysia, Philippines, and Thailand. I estimated the model using quarterly data from 96 to 2018, and I did trend the variables using a linear trend for the US and linear and quadratic trend for the EMEs. So let me show you the baseline. This is a $10 US dollar appreciation. As you can see, I mean, output in the US kind of go up with the real interest rate. And then for the EMEs, output contracts, investment goes down. Export, as I said, they move very little. Imports go down a lot. The real credit goes down a lot. The country interest rate, which is the country risk, goes up. And then the real exchange rate of each country, I mean, goes down, which is the flip side of this thing. So here's all the countries are together. If you look at the variance decomposition, the broad US dollar, I mean, explains about 20% of output and investment, much less for exports. And then again, for imports and credit, it's very important and less important for the country risk and the real effective exchange rate of each country. Then what I want to do now is mainly say, okay, if we put all the countries together, we see that dollar appreciation leads to output investment and credit contraction in EMEs. Which channel is making this happen? So then I'll have 4 different measures for each of the channels that I explained before. So for the dominant currency paradigm, I'll have the share of trade invoiced in US dollars for each of the countries. And then I split in 2 groups, one with high dollar invoicing and one with low dollar invoicing. For the global value chain integration, I use as a measure the import content of exports. There's some papers by several different authors that do that. Then a balance sheet channel, I just use mainly BIS data, but I also have some central bank data on the share of credit to the non-financial private sector denominated in US dollars. And then for the monetary policy credibility channel, I'm using a very simple measure here, which is just average inflation rate over the period. But I mean, if you use other measures such as the IMF has different measures of credibility, the split would be more or less the same. So I guess, I mean, it's not, it doesn't depend on this particular measure. We could use other measures if we want. This is the easiest one and more simple. Okay, so first, the dominant currency paradigm. So the blue is with high dollar invoicing, so countries mainly in Latin America. And the red is the low dollar invoicing. As you can see, if we invoice more in US dollars, your exports move less, which makes sense. It's exactly what the dominant currency paradigm tells you. But then your output falls more, your investment falls more, your imports fall more also, which is also, I mean, consistent with the dominant currency paradigm. And you have these different effects on the country interest rate and real exchange rate. So high dollar invoicing, if you have that and the US dollar appreciates, you contract more. But it's not that, I mean, it's flipping the side. Even the low dollar invoicing are also contracting. Then going to the global value chain integration. If you have high global value chain integration, is the blue one. And as again, I mean, mostly Asian countries, but now you also have Mexico. And if I have low integration, you have the Latin American countries and South Africa. And as you can see, one thing that's interesting is that if you have high integration, you see that the imports contract much less. And this is also the case for output investment and all that. And if you have low value chain integration, then the output investment and imports fall much more. And this makes sense because, I mean, in a sense, what I'm saying is that almost everything that you export have imports on that. So then they kind of go together. And that's what we are seeing in this bottom first 2 here and here. You see that they are almost, I mean, having the same effect. Then the balance sheet channel. So you have the high share of dollar credit, which is Peru, Colombia, Mexico, Chile, Argentina, and Turkey, and then the low share of dollar credit, which is Korea, South Africa, Brazil, and other Asian countries. And again, if you borrow more in US dollars, when you have a dollar appreciation or local currency depreciation, output goes down more, investment specifically goes down much more, and credit contracts more, which also makes sense. Finally, if you have high credibility, which means low inflation, it's the blue line, and your output contract less, investment a bit less, credit less, also, and if you have low credibility, then your output contracts more, investment contracts more, and the country interest rate goes up more. So, I mean, looking at these 4 different splits that I did, you can see that all the channels have some effect. But again, even for the low exposure countries, we don't flip the side. There will always dollar appreciations led to output contraction, investment contraction, credit contraction, and so on. Then, as I said, I did some robustness. I have the EME feedback effects on the dollar. So, I mean, is there any reverse causality stemming from feedback effects from EMEs to the dollar? This is the first one. Then I split the sample to look at the pre-global financial crisis analysis. So are the results related just to this emerging correlation between proxies for global risk factors and the dollar? There's this paper by Lille, Majori, Niemann, and Schreger. I guess now it's published at the Restat, which says that, I mean, after the GFC, the dollar is kind of a proxy for global risk aversion. So I mean, is this driving all the results? And then one thing that's important to note, it's, I mean, the countries that suffer more in the splits that I had before are also mostly commodity exporters. So is this just the relationship between the dollar and commodity prices being transmitted to these countries or not? So I include a measure of commodity prices to control for that. And what I find, if you put the dollar after the real activity variables for the AME, you see that the results are mostly the same. Of course, on impact, they don't move just because I impose that, but then they converge more or less to the same place. So it doesn't look like you have some reverse causality here. And also, when I do an EME output shock, I have a very small effect in the US dollar and the expected effects in EME variables. If I split the sample, looking at pre-GFC versus the baseline, what we see is that although output now contracts in the US and the real interest rate goes down instead of up, the effects on the EME variables are on the same direction, but they are, I mean, they have a quantitatively smaller, but they are on the same direction. So it's not that you reverse anything if you just go pre-GFC. And finally, if you include the commodity prices on the dollar, the impulse responses are very similar. Either if you put the commodity price after the US dollar, or if you put the commodity price before the US dollar.
Hey, Saber, one quick question, also regarding robustness. Your data starts at 1996, so
yeah.
They combine regimes with fluctuating exchange rate and fixed exchange rate. How you deal with that?
Yeah, you're right. So one thing that I did is that, I mean, so some of these countries they started with a fixed exchange rate, and when you go more recently, I mean, none of them are really free floaters, they're more dirty floaters. But if you say, okay, let's just drop the fixed exchange rate part, let's say start in 2000, we'll get more or less the same results. But they are, I mean, they're a bit weaker than what we see here. So the effects are a bit smaller quantitatively, but the direction is the same. I mean, we still have this. One thing that I could do is just have a control for that. I don't know, like some dummy for the exchange rate regime. I didn't do that, but what I did is just to check if we start in 2000 when most of the countries are floating, we would get the same results.
Okay.
Okay, so I mean, I think I'm ahead of time. I prepared to get more questions, but anyway, to conclude, dollar appreciations lead to GDP, investment, and credit contractions in EMEs and have very small effects on exports. And this is true regardless of how we divide the countries or which time period split you do. These results suggest that these channels that weaken or reverse these Mundell-Fleming traditional trade channels should be given greater attention when we build models. And we already seen that in the dominant currency paradigm paper by Gopinath and several co-authors. But I guess, I mean, we should incorporate this more broadly in small open economy models. And as I said, one important caveat is that the empirical model is agnostic about the source of dollar movements. And although we saw that in the robustness, and also I think that everyone would agree that US dollar movements are kind of exogenous to these AME's developments because we don't even have China in the sample. We could think that movements related to, I mean, if you have different US growth prospects or you have policy shifts like monetary or fiscal policy shifts, you could have different effects. So this is something that I'm not exploring here. Actually, I mean, I'm starting to work on that now, but I don't have any results yet. And then also just to emphasize that the pre-GFC evidence where the US GDP and real interest rate reverse direction, but the AME levels go in the same direction, suggest that these effects of US dollar movements could be independent of the source. But I mean, it's just a suggestion. So this is what I had. I don't know if other people have questions.
So, sir, it's kind of a question and suggestion. So, once you split the countries to try to disentangle the channels, in the end of the day, in most of your splits, you end up in one tier with a lot of Latin American countries, with the other tier with lots of emerging market countries. So, I'm not sure. I'm not convinced that you are truly decomposing those channels. So why not try a more structural approach in which we'll model all those frictions, all those channels, all those mechanisms, and check if the impulse response functions would be similar, would be different, so you can substantiate more your claims that it's this channel, not this one, and so
yeah. I agree. I mean, one thing that I was planning to do, but it was just, instead of just splitting the countries, I could have, let's say, a normalized indicator and put there and interact with the US dollar for each of these different channels, and then see, I mean, how if the coefficient is significant and how big it is.
Or at least some time varying. If those variables vary over time, perhaps you can mix more.
Yeah, that's exactly the issue. The issue is that I have, for instance, for the US dollar credit, I have since 2000 most of the countries. I mean, a good time series. For the dollar invoicing, it's kind of hard. I mean, I got more data recently, but it's not that I have some several missing variables there. So it's really the part related to both global value chain integration and dollar invoicing that I don't have the full time series. So I mean, it would lead kind to reduce, have a lot of missing data if I run the panel this way. That's why I'm not doing it. I mean, I'm trying to get the data, but I'm just explaining why I couldn't do it now. But yeah, usually if you look at the splits, I mean, the countries change a little bit, but the split end up being kind of similar. That's why I have also the commodity price control, because in the end, the countries that contract more when the dollar appreciates are mostly commodity exporters. But I agree. I mean, it would be better if I could just put everything together in the panel var or in the second panel var, and then evaluate the size and the significance of each of the coefficients using both the cross section and the time series.
Thanks, man.
Any other questions? guess not. So I guess we can end now.
Okay. Great presentations. Thank you for all.
Okay, thank you. Bye.